Hi everybody. I hope you are hearing me well. I'm happy to welcome you to this webinar introduced by the Institute of Risk Management. My name is Ahmed Barakat. I'm an assistant professor in risk management at Nottingham University Business School. And I'm going to give a webinar today on stress testing from a non-financial perspective. And stress testing is usually addressed in many lectures and many academic and professional workshops and seminars from complicated financial perspectives and points of view. And today we are going to take the enterprise risk management perspective, the ERM perspective, to discuss stress testing and how it can fit into the holistic view of enterprise risk management in all types of organizations. As we will see, it is usually mainly used in banks and insurance companies and financial institutions, especially following the most recent developments in the world economy and national economies. But we also will also try to address it from a broader view in all types of organizations, not just financial institutions, but also non-financial firms. So let's start first with taking a quick overview of our agenda today. We are going to discuss a brief definition of stress testing. Of course, we are not going to go deep into this because we will focus more on some practicalities of stress testing. And then we'll discuss the importance of stress testing for financial and non-financial firms. And then we will discuss some examples and main types of stress testing. And then we will see how the stress testing fits within the enterprise risk management framework, especially for the culture, the risk culture, and the organization culture relevant to the effective stress testing in public and private firms. And then we will discuss two important concepts relevant to the stress testing, which are risk tolerance and risk appetite, and see what are the differences between risk tolerance and risk appetite in relevance to the stress testing concepts and practices. Then we will discuss the types of data used in stress testing, and we'll compare what we call the economic or future-oriented data and historical or past data, and what are the differences and how they can increase or maybe reduce the effectiveness of stress testing practices. And then we will look at the internal reporting lines of stress testing. To whom should we report the stress testing results and methodologies, and any problems we have with the stress testing or any challenges, and then the benefits and drawbacks of external disclosure of stress testing methodologies and results with relevance to the supervisors and other types, and then how we can interpret the stress testing results and the future challenges of stress testing. So let's start directly with the definition of stress testing. In its simplest form, stress testing is some type of scenario analysis and making some kind of expectation and forecasting about the future performance of our firm, whether it is financial or non-financial. And the stress testing ranges from measuring the impact of a change in one underlying variable, for example, an interest rate or stock prices or foreign exchange rates, and as I said, the stock prices or the credit default swap spreads, for example, of our firm or other firms, or even the market index, and how these changes in these variables could impact or have a negative or positive impact on our performance or our financial position. So our performance is normally the operating profits or non-operating profits, like from discontinued operations, or the financial position, like the valuations of our assets and liabilities and equity. For example, if we look at some significant or substantial situations like wars or coups or even revolutions in some countries, so this could lead to the disruption or even the collapse or shutdown of our operations in one country or more countries. So, for example, we can assume that there will be a coup or a revolution in some country where we expect there will be some instability of the economy or of the political system, and then we try to expect or see what are the consequences of such changes in the economic situation of certain country and how it could be done for our situation. So, as I said, if we look at the problems we have, it could be like unsystematic problems, like caused by stock prices or changes or declines in the foreign exchange rates or interest rates, or it could be like a positive shocks to the stock prices and how they could affect our financial position and financial conditions. So what are the importance of stress testing? First, of course, it is an important tool for understanding what we call the economic balance sheet. The economic balance sheet is different from the normal accounting balance sheet. The accounting balance sheet is the assets, the liabilities, we have the equity, the components of equity. But if we are talking about economic, not accounting, accounting is about a past or historical performance, but economic is about the future performance. For example, in a bank, we could find a loan portfolio, but the number or the figure in the accounting balance sheet is relevant to the historical performance of the loan portfolio. But if we'd like to stress this number, to expose this number of the loan portfolio to some unexpected changes in the interest rates, like or the foreign exchange rates or sovereign risk, this could change the actual number or the actual figure of the loan portfolio or the loan exposure of a certain firm in the future. So here we are not talking about the accounting or the past performance, but about the economic or the expected performance in the future. Of course, as we will see, stress testing is an effective risk management tool for the enterprise risk management. So here we will not follow the silo approach or the silo effect, but we will follow a more holistic approach for the risk management in our organization. Here, as we will see, we will have to have some kind of introduction and collaboration and discussion from different departments and between different divisions of the firm to implement the stress testing as an effective risk management tool. Also, stress testing is used as a way to meet the prudential requirements of regulators, and this is a very important and crucial use of stress testing. For example, in the European Union, the European Banking Authority has introduced the stress tests in European banks in 2009, following the great financial crisis. And also in 2009 in the USA, there was what we call the SCAB, or the Supervisory Capital Asset Program. And this was relevant to the assessment of the equity and the capital ratios, like Tier 1 ratios, of the banks in the US. And this was a requirement to introduce some capital relief or some asset relief program and some capital injections into some banks. So here it is very important for many banks and insurance companies to implement trustable and confident stress testing and trustable stress testing methodologies for the regulators to assess their capital adequacy and their exposure to future risks. Also, the stress testing helps to improve the robustness of the financial sector and real economy, again because it introduces the individual banks and their regulators and supervisors with an overview of the actual expected or the actual performance and how this actual performance and the actual financial position can be translated into future revenues, future losses, future unexpected declines or reductions in the profitability and liquidity of some banks. So here we can introduce some expectation of the resilience of some banks and therefore the whole financial sector, and therefore improving the efficiency of the whole economy, not just the financial sector. And finally, of course, if we are talking about all this, so stress testing is very important and crucial for the social security and welfare and the social justice, because it helps with redistribution of the wealth, at least for the central banks, as the last resort of help for banks, for the central banks to be able to redistribute their capital injections and any packages they can introduce, maybe to banks with the most significantly expected problems in the future. So, after we have talked about the importance of stress testing, we will move to a very important point, which is that stress testing must be well designed. So, for example, I will give like a non-financial example. If we are talking about property safety, so when we are designing and establishing a new property, so we have to model the expected strength of earthquakes and any environmental factors on the foundations of these properties. The importance of such tests is higher in some countries which are more exposed and more vulnerable to earthquakes, like Japan, maybe more in the UK. Maybe in the UK you have to care about, for example, flood risk, because maybe the flood risk is much higher in the UK than in Japan. So here, in the end, it may be more cost-effective to do the flood risk stress testing in the UK, or the earthquake risk stress testing in Japan. So again, it depends on the situation and the cost-benefit analysis for the weights of risk, or what we call the risk-weighted assets, or the risk weights in center or specific countries with comparison to other countries. So there is no one-size-fits-all for the stress testing, but as for this example, it depends on the nature of risks and types of risks your country, or sorry, your firm, in this example, your property, is exposed to, and in which circumstances and in which countries. And in the end, it would be better to do it anyway to save both lives and the properties. That's what we call the social welfare and the stability of the country, the economy and the financial sector as a whole. So, what are the main types of stress testing? There are several approaches to model the types of stress testing, but the most acceptable way is to divide the types of stress testing into three main categories. The first is the sensitivity test, and here we are assessing the impact of only one financial variable. And maybe a very simple example of a sensitivity test, for example, is discounted cash flows analysis. So here, if the higher the interest rate, or the higher the discount rate, so the lower the expected cash flows. So here you are measuring the impact of only one financial variable, which is the discount rate or the interest rate in the market, or the market interest rate, the fluctuations in this discount rate on the expected cash flows. So here, this is a sensitivity test. But a scenario test is, which is the second type of stress testing, is much more complicated, and here you have to develop a whole scenario. And this is what we are going to talk about for the rest of this webinar. Scenario test is assessing the impact of several variables on the financial performance, the future financial performance and the condition of our firm. So, for example, we will not only talking about the interest rate, but we will combining, for example, some changes or some simultaneous changes in the foreign exchange rates, or even our performance, like our internal operational risk, like fraud exposure, or IT risk, like the vulnerability of our IT system to some hacking damages of external sources. So here, the scenario test is usually what is meant by stress testing in the financial and non-financial context. The final is what we call the reverse stress test, and this is usually overcome in the professional and academic literature. And here we are we are going the other way around. So we are starting with an expected performance. For example, we would like to know what are the factors that will cause our performance or our profitability to reduce or to decrease by 10% or to become negative, that we will achieve a loss in a certain year. So here we are not making hypotheses about the financial variables, but about the final impact of these financial variables. As I said, what are the financial variables that will make us achieve a loss in a certain year? Or, for example, our assets will be reduced or by a certain percent, like 20% or 30% or whatever. So in this case, and of course the ultimate case we will discuss is the financial collapse of the firm. So here, if we are, for example, we go bust or we go bankrupt or we are liquidated. So what are the changes in interest rate, in our exposure to credit risk or liquidity risk or market risk that will cause our firm to collapse and lose credibility all over? So if we are talking about simple examples of stress testing, so I have chosen here like two main types of risks, what we call financial risks and non-financial risks. For financial risks, for example, we are talking about the market, credit, and liquidity risks, and of course they are the main financial risks in many banks and financial institutions, insurance companies, and so on. So, for example, we can consider a stock market scenario based on the events of the great financial crisis of 2008. And what do I mean by the events of the great financial crisis? This could differ from one firm to another. For example, in a bank they will focus on the illiquidity that has happened in the subprime markets or subprime mortgage markets. And for insurance companies, for example, they could focus on the insurance policies that have been triggered by the great financial crisis. So here the perspectives from which you look at the events, what we call the events of the great financial crisis, again, this is idiosyncratic. This depends on the special nature of your organization. So again here, my advice is that if you are a risk manager in a financial institution, so you don't just have to follow the manuals of other firms, for example, your competitors, because maybe their views and their expectations and their objectives and their culture, even their culture, are very different from your firms. So here, even when you are anticipating a scenario for your stress testing, the most important advice to follow is that you first analyze your firm. You first analyze the situation of your firm. And don't just depend on the public data available. For example, there are some private or some publicly available data on operational risk events and announcements in other firms that's trying to use it and incorporate. But the major fault and major error made by risk managers that they take it as a copy and paste strategy. And this is not recommended at all, and has very serious consequences if you just depend on the analysis introduced by other firms, or by, for example, by audit firms of your competitors, and so on. No, just depend. The starting point is always the situation of your firm, and then you start looking at the events and the scenarios you are analyzing. For non-financial firms, for example, like operational security and the IT risks, for example, you can consider the terrorist attacks of 9/11 and the simultaneous hacking damage to a database. So here you are using an actual event like 9/11, where you can, for example, anticipate that the New York Stock Exchange has been closed or was closed for 5 days following the attacks. And then this is something you know from the history of the event. And then maybe you had like your own anticipation of a hacking damage to the database due to the database of your customers' information or your suppliers' information or whatsoever. So here again you are combining an actual shock, which is a terrorist attack, and your anticipation of another problem or another drawback, which is a hacking damage. So again, here you are not analyzing one variable but several variables. Other type of stress testings is what we call the natural catastrophic analysis. So here, this is relevant to the natural disasters and not just the financial disasters. So the financial disasters, as I said, is relevant to like some collapses in the markets, some illiquidity in some markets like the subprime markets and mortgage markets following the great financial crisis or in the wake of the great financial crisis. But also the stress testing could be relevant to the natural catastrophic analysis, like analysis of some hurricanes and earthquakes, as I said in the property safety example. Here you have to know that, for example, for the hurricanes and the earthquakes, because in the Japan or in the US, because they are more frequent than other countries, so it is much easier to model such events. But for other events like some tornadoes or some sinkhole subsidence or brush fires, maybe they are less frequent in other countries, like some Middle Eastern countries, and therefore it is a low probability events. The low probability events are much more difficult to model, and here you have to use the concept of what we call the plausibility, not the probability of the events. So the plausibility of the events is relevant to how much the event is plausible, is possible. And it is very subjective concept, and here you have to supplement the stochastic models, the statistical models you have, with some professional judgment and the use of subjective judgment from some experts. So let's move to a more interesting part, which is how the stress testing could fit into the enterprise risk management. So what are the kind of culture, whether it is risk culture or organizational culture, that we need to incorporate to make an effective stress testing? By the culture here, I mean the risk managers. So here, the risk managers and the risk officers have to understand some concepts and some cultural concepts and terminologies and the practices to enhance their using of stress testing. The first is that they have to introduce what we call the challenging scenarios. So here, you don't have to make like a readily available scenarios, but you have to make like challenging scenarios to make the highest stress to your portfolio, whether it is loan portfolio, stock portfolio, foreign currency portfolio, property portfolio, whatever. So it doesn't make a difference. The difference is that you make a challenging scenario. How can you make a challenging scenario? Not just, as I said, by looking at public data, but you are looking at your history of performance and the history of your sector and the history of your competitors, and try to take the most challenging and the most serious problems they have. And then, in addition to the challenging scenarios, you have to use a robust quantification. And here, again, you have to use the services maybe of some external experts or some professional experts who have experience in, for example, the value at risk models. And here you have to be careful about especially the assumptions. So the assumptions here, for example, is how much confidence are you giving to your VAR? Is it value at risk at 99% or 95% or 99.99%? And this makes a difference. Why? Because it's costly. So if you are going to pick, it is at 99.99% VAR, value at risk model, so maybe you have to collect more information and incorporate more complicated models to do your analysis. So it is not just about assumptions, but these assumptions will cost you money. Therefore, the stage of discussion for you as a risk manager with your team and with your board of directors and with your risk management committee and with your chief risk officer and so on and of course your CEO, is very important before you start the actual quantification of your stress testing models. We are not going into any quantitative models to make it simple and because we are focused on non-financial perspective, but as I said, my advice and the advice of experts is that you focus on the assumptions before the beginning of the quantification, because the general problems we see in our analysis and our consultancy for many firms that they have made a lot of expenditures and invested high money in quantification and quantifying some variables, and later on just to find out that they were useless. Why? Because they didn't study the assumptions in a very thorough way and in a very clear way to their objectives and their past and expected future performance. Effective communication. Here this is very important, especially for firms which have risk management committees. Many firms have started to establish what we call the risk management committee. And the risk management committee is not just an executive committee, but it is a part of the board. It is a board level committee. So here you have to communicate your, as I said, your plan before you start doing the stress testing to your risk management committee and chief risk officer. And also, so first you have to discuss first with your colleagues and with your juniors and with your employees, and then you start discussing with your seniors. And then you make like go and come feedback. So you discuss with your colleagues and then with the risk management committee and chief risk officer. And then finally the mitigating actions. So the stress testing is useless without any feedback. So why are you doing the stress testing? Because you will find out that some changes in some variables will cause problems or will cause declines in your stock prices or in your profitability or even in your reputation. As we will talk, your reputational risk. So in this case, you have to develop a framework to get some benefit from the results of the stress testing. So don't do the stress testing only for the regulators or for your managers, but try to use the results and to make some feedback to improve the performance in the future. And the important point here is documentation. Please try to use very good documentation for your stress testing results, because again, a lot of, for example, of meetings for the stress testing in many risk managements are not documented. Okay, there are no any minutes for the meetings. There are any briefs of the meeting. So here it goes useless. You have to have like some kind of recording, some kind of documentation for your meetings and all your efforts. The more you document it, the more you have a history and you have more information to advise your future stress testing and to benefit from any problems you have in the current stress testing. So what are the attitudes of risk managers for effective stress testing? What are the characteristics and the traits and skills the risk management should show for the effective stress testing. And this is also used when doing some interviews, for example. So when we are interviewed as experts, some interviews, we are trying to find out if the applicant has these skills and can show these skills and attitudes if he will be involved or she will be involved in effective stress testing and will be delegated some stress testing jobs and tasks. The first, of course, is the creative thinking, the brainstorming, and expecting of the unexpected, okay? So this is clear, as here you don't have, as I said, to depend just on the history or the performance of your firm or other firms, because, for example, as a great financial crisis or as even the revolutions or cause of some countries, maybe they were not expected at all. Therefore, you have to make some brainstorming what if analysis. What if analysis, of course, as we will see, we will produce maybe hundreds and thousands of scenarios. And here again comes the subjective judgment of which of these hundreds or thousands scenarios could be the more plausible. Not even the more probable, but the more that has higher plausibility, higher possibility. So again, this needs subjective judgment. But at the first step, you have to have some kind of brainstorming and creative thinking to introduce hundreds or dozens of thousands of scenarios, then reduce them to a handful of scenarios. You have also to better understand different types and sources of risk and combine history and future. For better understanding different types and sources of risk, the importance of this slide here is not just the attitudes, because maybe it is expected for you. But what I would like to discuss this only because it indicates the skills you need to find in your new applicants or in new risk managers. So for example here, better understand different types and sources for risk. So here maybe you have to look at the training of your continuous training of your staff. Again, continuous training could be something like this webinar, or having like a professional qualification or some continuous professional development and so on. So this is very important to understand the new types of risk, because each day we have new types of risk, new types of IT risks, of operational risks, of Ponzi schemes, for example, in the financial institution and so on. So we have to be updated. The best way to update our staff is to make a continuous professional development, and the investment here is very important. Combine history and the future. As I said, the documentation here is very important because you have a documented history, and then you could add your subjective judgment about the future. And then the final thing is be responsible and stay accountable. The first is more self-defined, and the second could be imposed by accountability lines and responsibility lines and some bylaws and internal regulation and even external regulations. So here, be responsible. This could be your feeling. This could be your self-attitude. Or stay accountable here. This is for the organization and for the firm to establish a good, what we call the corporate governance code for the firm. The corporate governance code of the firm could be developed by the risk management committee or the corporate governance committee to impose some punishment, some sanctions on the people who do not follow the regulations, because inaccurate stress testing techniques could be disastrous to the firm, because you will ignore some substantial risks that you have had to look at. So, how the second thing, or the next point, is how stress testing fits within the enterprise risk management. The stress testing is and should be central to the enterprise risk management, and it should constitute a part of the holistic enterprise risk management, as we said, the feedback system to the our managers and our board about the future, even least likely events. So here the stress testing is not just about, as I said, silo approach that is done in each department, for example, the trading desk separately, and then the operational department in a manufacturing company separately, and so on. No. Here we have to sit together and have not just exchanging emails, but again, by communication, I mean that people should meet in person. So this is again a very big fault made by many organizations, that you just exchange emails, exchange phone calls, and that is it. It's not enough. If you are in the same headquarter or very close, I would strongly recommend that you meet, for example, the head of the expenses department, the head of the manufacturing department, the head even of the marketing department, and so on, and COO, and try to meet as frequently as possible in person to discuss, because only exchanging emails and making like long distance calls, and here this makes like some kinds of barriers between your managers, and this will not help the stress testing. For the stress testing, you have to discuss the hypotheses you have and the scenarios you have in person with all the persons and managers involved in your country, in your firm. So here, my advice is that, yes, use emails, of course, and this is fine, but please try to meet in person as much as possible to discuss your stress testing methodologies, the stress testing practices, and then the results, of course, of the stress testing and how they can be fit into your future performance and future financial position. Here comes two important concepts, which are the risk appetite and the risk tolerance. So the stress testing should be relevant to the risk appetite and risk tolerance. So what do we mean by the risk appetite and risk tolerance, and how they are relevant to the stress testing? As we can see from the graph in front of us in this slide, we have in the first line or the first range, this is the whole range of possible outcomes, ranging in the red parts in the to the right, or to the extreme right and the extreme left. This is the extremes of the performance, whether they are, for example, very high profitability or very high loss. And then the parts with the blue or light blue, they are relevant to the expected range. For example, we are expecting profitability from -5% to +5%. This is the blue part or the blue range we have. But if we achieve, for example, more than 5%, up to 10% profitability or loss, this is the red parts. So the risk appetite is relevant to the normal conditions or regular conditions. And the risk appetite indicates the range of risk exposure to which our management and our board of directors of the firm is willing to accept, and is fine with accepting this range. Again, as I said, for example, from 5% to plus to 5% minus. Usually, no organization is willing to accept a loss. I understand this, but I'm just giving an example. Usually, but again, if, for example, you are in the turmoil of the great financial crisis and you are seeing all your competitors are doing losses, so maybe in this case, the range of your risk appetite will increase, because you will find that your competitors are doing bad, are making losses, are having problems. So the risk appetite is changing again from one year to another, from one sector to another, from one country to another, and so on. But again, the risk appetite indicates the range of results and the range of risk exposure to which your firm is willing to accept. The risk tolerance is relevant to the relatively abnormal or temporary conditions. And the risk tolerance is much wider than the risk appetite. For example, from 7.5% profitability to 7.5% loss, for example. So it is in the middle between the risk appetite, which is 5%, and the extreme range, which is the fourth band we have, the unacceptable range, from 7% or 7.5% to 10% and so on. So here, the stress testing you will do depends on your risk appetite and risk tolerance. So what is the objective of the stress testing within risk tolerance and risk appetite? As we can see in this slide, the stress testing is relevant to keeping our results within the risk tolerance. So here we will find on the horizontal axis the fiscal year from 2014, the current fiscal year, to 5 years ahead, 2019. And then on the vertical axis we have the return on assets. So as we can see, the black line or the black curve, this is the original situation. So this is our anticipation or expectation of our performance in the future. So everything seems fine, and we are expecting that our return on assets, ROA, will increase consistently and steadily over the next couple of years. But we would like to stress and expose our expected performance or our forecast for the next 5 years to any shock, as we will see in the next slides. For example, shock to the interest rate or the stock prices or other factors in our sector and our economy. So the original situation of the black line will be changing to the red line or to the red curve. So as we can see, instead of a consistent increase in profitability, we will find a sharp decrease from 8% to 4% from 2014 to 2018. And then we expect some slight increase from 2018 to 2019. This is the red line. So this is the stress. This before applying any risk management. And here comes what I call the feedback, the mitigating actions. As I said, it will be a blow in the air and useless effort if you just apply the stress testing techniques and then make no feedback and no use. And take my word, many firms do this, especially in some small banks and some medium banks, because they just do the stress testing for the regulators and for the supervisors and just to fill in the gaps and tick the boxes. This is a very serious mistake. The stress testing, if you have already invested in your stress testing and there is a high cost, so please make a benefit from it. Not just cost, but make some beneficial use of your stress testing results. So if you use the stress testing results beneficially, you will be in the green line. The green line on the graph on front of us, this in the middle, as we can see, we have kept our performance within the risk tolerance. The risk appetite is the one with the light blue, and the risk tolerance is, as I said, the wider range for with the orange color. As we can see, we have gone in 2017 slightly outside the risk appetite range, but we are still within the risk tolerance range. So we have done our objective, or we have achieved our objective from the stress testing results. So again, it's very important to make your judgment about the risk tolerance and risk appetite. And who are responsible for the risk tolerance and risk appetite? Mainly, if you have a risk management committee, a board level, so this will be the main body responsible for determining your risk appetite and your risk tolerance, of course, after discussions with the chief risk officer and risk officers and other risk managers. But because the risk management committee is a delegated body of the board of directors, therefore it is very important that risk management committee is aware of your firm's risk tolerance and risk appetite. So if we are going to more technicalities, but again non-financial technicalities, we have not now talked about the culture of stress testing. So the most frequently asked question I received is why can't we just use probabilistic simulation models? So why can't we just use probability using historical data, and that is it? So why the stress testing, and we have to do some subjective analysis and professional judgment? Generally speaking, to begin with, subjective judgment is crucial for estimating low probability events. Again, as I said, if, for example, you are in an area where the probability of earthquakes or hurricanes is very low, so you have to make your subjective judgment and professional judgment of the consequences of such events and some natural events on your property safety or on your business and so on. Even if you are working in a country where it is politically stable, you have to do some analysis of any potential impact of some unexpected problems. Okay, for example, as we have seen in some countries, like in Turkey in the last week, there were some unexpected political results. So here you have to expect something like this. Could it have, I don't mean, of course, Turkey in specific, but I mean in general, in any other country, if there is any unexpected political result or instability, would this have any effect on your firm, on the performance on your firm, on the demand on your firm, and so on? So here, some scenarios also represent sharp breaks with history. So, for example, if we have, like for example, if we have some sharp breaks with history, for example, the Great Financial Crisis, okay, it represents a clear example, and it was not expected at all. And if we look at any expectations of the performance of any banks in the US or in Europe in 2006, you will find no indication of any problems in the subprime mortgage markets and so on. So here, also some scenarios do not relate to the public price observations at all. So they are not relevant to the market prices, but they are relevant to idiosyncratic factors of the firm. Okay, for example, its performance, its exposure to some operational risk or IT risk depends on its own circumstance. Again, some variables are unquantifiable. There are some unquantifiable risks. For example, the reputational risks or the strategic risks. How can you measure strategic risk or reputational risk? This is very difficult, of course. So here you have to make your own judgment. And, for example, there has been some literature and some professional and academic papers trying to measure the reputational risk by the drop in the market prices or the price of the market prices beyond the actual losses, okay, made by some operational risk events and so on. This is fine, but again, this is one point of view. This is one perspective, okay? This is not all the reputational risk. So here you have to model your reputational risk and break it down into your relations with your suppliers, with your customers, with your regulators, with your supervisors. So here, it is difficult by nature to quantify some risks. And again, the plausibility of contagion. The contagion is very important, and as I said, for example, the fair value accounting in the Great Financial Crisis has caused some what's called fire sale assets due to the fair value accounting making some contagion effect, because the decrease in price of some assets in the market due to other banks or other institutions selling their assets could be transferred to our balance sheet, because we have to value our assets into these reduced prices, and therefore this has made contagion effect. Again, this contagion effect, sometimes it is difficult to quantify, and you have to make some subjective judgment and scenario analysis, and here comes the stress testing. So what are the types of data used in stress testing? So now we have found out that probabilities are not sufficient to make a good expectation or forecast of the future, because there are unquantifiable risks and so on. So what are the types of data used in stress testing? They are future-oriented and past-oriented, or historical-oriented. Future-oriented data is used in what we call the economic stress tests. So here, as we can see on the slide, it incorporates economic insight and professional judgment and experience and subjective judgment to generate plausible scenarios. Not probable, but plausible. Again, plausibility against probability. Probability is more objective, while plausibility is more subjective. And it depends on experience. And again, if you ask, what does this mean? This means that if we are talking about history, about probability, you can't just depend on numbers, on figures, on computers, on software. But if we are talking about economic stress tests or future-oriented stress tests, you have to rely more on people, not on software. So you just feed, in history, historical stress tests, you just depend on the past historical data and just feed it into some model software, and then you get some scenarios, and the most likely or the highly likely probability or scenarios. But for economic stress tests, you have to depend on people. So here, this determines your investment. Would you invest more in software and PC software, so you are doing historical stress tests, or you are investing in people, in experts, to get their professional judgment and their professional experience, so you can make some anticipation and forecast of the most likely, or as I can say, the most plausible scenarios. So economic stress test is about the future. Historical stress tests is about the past. So economic stress tests. Let's go into deep, because it's very important to distinguish between these two types of stress tests, the economic and the historical stress tests. The economic stress test is, of course, very complex, and it indicates that it is very difficult to work plausible combinations that can induce the firm's failure. Because again, as I said, it depends on your professional judgment and the professional experience, and it could be difficult. But sometimes it is more trustable than software, because software will only depend on historical data, so there is no new information. Okay? Even if you have to include some expectations or some forecasts or some variables, so again, the software will not give you everything. You have to incorporate this, not just about interpreting the results of the stress test, but about the assumptions underlying your stress test. So the economic stress test, its assumptions is about what we call the plausibility, not the probability, and the plausibility is a subjective notion, and it depends again on the professional expert itself and its background. And here comes a very important advice, that you have to rely maybe on financial experts or experts in your industry. So here comes the comparison between, do you need a financial expert, or do you need like a industry-specific expert? For example, if you're working in cars, or you're working in the auto industry. So here, do you need a financial expert, or most of them are financial experts or industry-specific experts? Again, it depends on the type of scenario you are making. If you are making, for example, about your stock price response to some announcements or some new changes in the industry, here maybe you need a financial expert, because you are talking about the stock prices or the CDS spread, the credit default swap spread, or anything like this. But if you are talking about the vice versa, for example, the impact of some changes in the demand in the industry, or in the demand in the market demand on your operational strategy or manufacturing policies or strategies. So here maybe you will need more an industry-specific expert, not a financial expert. Or at least most of your stress testing team will need such experts. So here again, economic stress tests need a lot of judgment about the types of experts you need, because you will depend on their advice and their expert. So here you have to make a good decision whether to rely on professional experts or financial experts. So how can we conduct a successful economic stress test? Again, here you will depend on people. Yes, maybe you depend on software or you depend on some historical data, but most of your work will depend on subjective judgment about the future performance of your firm and the future circumstances surrounding your firm. So the first thing is to split the work between a senior group and specialist groups. The senior group will do some analysis of the main variables. For example, if you are talking about the great financial crisis, so they will work out, the senior group, the main group, will work out the change in the liquidity of the subprime mortgage and the stock prices and the interest rates. And then the specialist groups can work out the other less important variables. Okay? For example, a change in the demand on some other variables or some other markets or some other products. And then you have to make sure that the work of the specialist group does not create any inconsistency into your stress testing work. For example, two specialist groups may be working, and then the result of this group is that one increase the interest rate by 2%, and the other group they reduces the interest rate by 2%. So here again comes the importance of personal meetings, the personal communication, not just emails, not just phones, but personal communications, and then discuss and put all the hypotheses on the table. And all the groups meet frequently, like once a week, monthly, and so on, according to the situation, and then discuss the hypothesis and the progress of the work. Because again, in our consultancies, we find that in the end of the project or the stress testing project, maybe there are some inconsistencies and conflicts in the work of subgroups. And therefore, some subgroups have to redo all the work from scratch. And this is, of course, too costly. Again, we have said that we can reach hundreds and thousands of scenarios, and of course, realistically, it is impossible to, from the cost perspective, to analyze all of these scenarios. Therefore, you have to reduce these scenarios to a handful of scenarios. Maybe 5 scenarios, 10 scenarios in each field. And again, here you have to discuss, and in this case, not just with your colleagues and the specialist groups, but with the chief risk officer and the risk management committee, and even maybe with the COO and the other delegations of the board of directors. So do determine the actual hypothesis to be used. Please try to make a more contacts and more discussions with the board of directors and your senior colleagues. Again, you have to be realistic about your assumptions, and this is the fourth step we have to do. Anchor the assumptions for the move of a particular variable to the largest historical move in similar environments. So here, this is very important, that, for example, you don't analyze the stock prices just in your market or your stock market, but in all stock markets where this share is listed. The credit default swap spread in all markets where the swap is or the derivatives are traded. So here you have to make a more holistic view. This is the 5 things. Don't use a narrowly drawn group. Don't reduce your assumptions to like specific market or a specific sector or something. Try to take more points of view. So it doesn't mean that I am telling you to reduce it to a handful of scenarios
to ignore some important assumptions or ignore some declines in some markets. You have to take, usually the assumption about the scenarios, you have to take the most negative move, for example, in a stock price as the scenarios you are expecting. Okay, this is to make your scenario fruitful and successful. Okay, so don't ignore like big declines because maybe it will cost you some money or it will cost you make some pessimistic view about your performance. No, try to take the most negative performance of interest rates, stock prices, and so on to make your stress testing methodology successful. And finally, consider carefully which variables can plausibly move together. So what are the relationships between the stock returns and the interest rates? Are they moving together or in opposite ways, and so on. So here what we call the combinations of variables and correlations. So you have to include the correlations between variables and don't analyze the variables in silo effects or in silos. No, try to study the correlations of different variables to enhance your understanding of the holistic view of your stress testing. Again, here you have to use the help of some professional experts and maybe financial experts for their expectations about the future. So what does this mean for historical stress tests? Historical stress tests are maybe less complicated than economic stress tests, and because, as I said, they depend on historical data, and maybe they cost less than the economic stress test because there is a high intensity of effort invested to generate hypothetical scenarios in economic stress tests. And here you have to have like some kind of good software to analyze your historical data. And again, you will need maybe some professional experts, but not as much as you need for economic stress tests, because here you will need mainly to analyze the results of your stress test, but maybe not as much to do the or to design the methodologies of your stress test. So maybe the investment will be much lower, that's fine, and this is an upside, but the downside risk is that maybe you will have less accurate results because you have not incorporated the professional judgment of or the professional expectation of your experts. So again, usually we have two types of historical stress tests. The first is called the factor push stress test, and the other is Monte Carlo stress test. The factor push stress test, here we determine the plausible maximum up and down, maximum up move and down movement for each variables, and make some kinds of combinations between the maximum ups and downs. And we will receive, or we have several, of course, scenarios of ups and downs, and then we use the computer software to determine which of these combinations of ups and downs, of the maximum ups and downs in the variables, may cause the negative or the most negative impact on our profit and loss or stock prices or reputation and so on, our target variable. So here, again, you have to understand how to get the maximum up, move, and down. And for historical test, of course, you will depend on the history of the performance of the variable in your sector or in your financial market or in other markets. So here you have to understand that the maximum movements or the extreme outliers are not just confined to your sector or your field, but you have to give a broad view and a broader view of the movements. But what about another type of historical stress test, which is Monte Carlo? Here we have to incorporate some kind of plausibility. Okay, so here the Monte Carlo is some kind of mixture between the economic stress test and historical stress test. So here you have to combine some plausibility with some probability measure, because one resistance and one problem with the factor push stress test is that the correlations, or what we call the combinations, are usually destroyed in crisis events. So even if you are anticipating that stock prices will be relevant to or will move in a certain way or in a certain behavior according to the illiquidity in subprime markets, this didn't happen. Actually, this didn't happen, or didn't happen in the great financial crisis. Actually, there was totally unexpected movement in some stock prices and some CDS spread during the financial crisis. So here you have to develop hundreds of scenarios using the Monte Carlo simulations, and also how we can determine the plausibility of these events. So the plausibility here does not only depend on the probability, but also on the professional judgment of experience. So for Monte Carlo stress test, it needs much more investment in people and in skills, more than the factor push stress test, which is straightforward depending on software. So now let's move to another part of our stress testing, which is very important: the internal reporting and external disclosure of stress testing. Of course, if we are talking about reporting, here we have to establish very clear reporting lines for stress testing. And the magical word here is categorization. You have to categorize your reporting on stress testing. For example, as it is mentioned in the slides, there has to be reporting on, or reports on stress testing for trading desks, for business lines, for regional territories, for different sectors of your operations, and so on. So here you have to design the stress testing hierarchy to match your organizational structure and the critical risks you face. So the main types, or the main two things you have to take care when you design your reporting lines and your reporting framework for the stress testing results is, first, what is the organizational structure? Am I working in only one country, in only one territory, in only one sector or several sectors, in only one country or several countries? What are the circumstances? Are there good lines of responsibility and accountability between these departments and divisions, and so on? And then the critical risks, because by nature, some types of firms are more exposed to some types of risks. Like, for example, manufacturing firms are more exposed to maybe operational risks than credit risks, and vice versa for banks and insurance companies, and so on. So here your stress testing should be, and I mean by stress testing is investing in stress testing. You should invest in stress testing for the more critical risks for your organization. And here comes what we call the drill down capability, that your reports should include, and here I would advise that you introduce the reports in electronic form, so not just like paper form, but in both of them. So it's very important always to keep a good record for the electronic forms of the stress testing reports and the methodologies, and to get some approval on your methodologies and feedback on your results of stress testing from relevant parties, whether they are the relevant division managers or the relevant heads of departments, or even the chief risk officer or risk management committee, or the annual meeting of the annual general meeting of shareholders, and so on. So here, the reports of the stress testing has to have some kind of drill down capability, so that more critical risks and the more significant risks can be further broken down, can be more significantly and more substantially analyzed to get better understanding of how we can manage such risks and improve our exposure, or improve our resilience with regard to these risks. And finally, you have to establish a feedback framework. Again, as I said, the stress testing is useless if you don't have any feedback system. And the feedback system has to be accepted and approved by the Risk Management Committee and the Board of Directors to coincide with the whole corporate governance of the firm. So it is advisable that this feedback system is established when you first establish your firm, but it has to be updated frequently, maybe each year or each 6 months. It has to be some kind of meeting to discuss the feedback system on several stress testing in several departments and several divisions to benefit from the feedback of, so the reporting here is not relevant only to the stress testing methodology, but also to the results of the stress testing, both the methodologies to make a successful and efficient stress testing, and then reporting of the results to get feedback and think about what can we do, or how can we improve our operations and our strategies to address such risks. So if we have talked about internal reporting, so something natural and natural extension, that we talk about the disclosure of stress testing. And this is a very hot topic today on academic and professional literature, because maybe stress testing is, regarding disclosure, I mean, not practices, is a recent trend to disclose on stress testing. And for example, more recently in 2009, the European Banking Authority have started to disclose the results of the stress testing in the European banks, and there was a similar action in the US, as I said, the SCAP, or the Supervisory Capital Assessment Program, to stress test the capital adequacy and the capital ratios and Tier 1 ratios of banks and insurance companies, or maybe I would say banks, not insurance companies, banks and bank holding companies. And now it has become consistent. So if you look, we will have what we call the DFAST, or the Dodd-Frank Act stress test in the US, the Dodd-Frank Act stress test, and also what we call the CCAR, the Comprehensive Capital Assessment Review in the US. And they are relevant to stress test the, as I said, the operational profit and the loan loss portfolio and the loan portfolio and the loan losses in several US bank holding companies. So some firms have started to disclose their stress testing methodologies in their annual reports, usually because they have been asked for by the regulators. For example, in the US, the Federal Reserve and the Board of Governors have asked the banks, the US bank holding companies with more than 50 billion in total assets, to disclose what we call the mid-cycle and annual stress tests of their capital ratios. So this indicates that it is very important to invest in stress testing methodologies and the mechanics and capabilities of the firm and the bank to provide successful stress tests and trustable stress tests. And as you can see, you will find that the results of the stress tests, of the annual stress tests in the US bank holding companies, are different in the annual reports from those in the regulatory documents. And this means that even with the same assumptions, maybe the professional experience of regulators is different from those of the individual banks. So here comes that we have to rely on a more professional experience and more relevant professional experience to provide a good stress testing and a good disclosure of stress testing. There are ups and downs for disclosure on stress testing. The downside risk, of course, is that our competitors might benefit from the disclosed stress testing results. So here, again, this is, of course, understandable, but now maybe the benefit we can get from the confidence of our customers, because especially after the great financial crisis, there has been a documented evidence that many customers have lost confidence in the annual reports of many banks. And now, for the customers to understand and believe in the company or the banks, they have to introduce, the banks or the financial firms have to introduce more trustable stress testing methodologies in their annual reports, so they can outweigh the downsides of their competitors, knowing about the stress testing methodologies, by the benefit that customers can get their confidence or increase their confidence in the performance or the future performance of the firm. So how we can interpret the stress testing results? The most important thing is, what does this say when we look at the results of stress tests? What does this say about the firm's resilience? So here, the results may indicate level of securities that is too high or too low. So if it's too high, this means a very high cost, and therefore we have to maybe make a more cost-benefit analysis, or maybe the level of security or the level of guarantee we do is very low. So for example, if we are talking a very high security, that we are having very high capital, unused capital, so we can release some of this capital to increase the efficiency or effectiveness of our future operations. But if we have very low security, very low capital, so we need to inject more capital to enhance the stability of our organization. Since the stress testing results are very concrete and very intuitive, therefore they facilitate a very good communication with board level bodies like the risk management committees, and it presents you with a risk manager or chief risk officer a good opportunity to understand the demands of your colleagues, the demands of your customers, and then to discuss these results with your seniors like the risk management committee or the chief risk officer. So you can use the stress testing is not just as an analytical way or an analytical tool, but also as a communication tool, because now you have the right and the duty to deliver or communicate these results and discuss it with your seniors. So use this chance, use this opportunity by enhancing your communication channels in the communications in your organization. Of course, the explanatory power will be very clear if we are talking about one variable, and this is very rare. So if it is more complicated when we are using scenario of many variables, so you have again to make a good communication channel to your seniors and the board of directors, and it gives also the leaders of the firm, especially the board of directors or the risk management committee, a very good opportunity to reconsider some of their priorities. Okay, so in this case, they can close up some operations, enhance investments in some other operations, and so on. So as I said, interpretation of stress testing results provide a way of an effective communication, of reconsidering your security, your capital, for example, in banks, to increase your capital to support stability, or reduce your capital and release some of it to enhance your operations, and also for your leaders to reconsider the strategic risk of the firm by considering the strategic decisions and strategic objectives of the firm. So, as we are coming toward the end, final thing is the future challenges of stress testing. The future challenges of stress testing are broad and are too many, because stress testing is very new to the organizations, especially in terms of disclosures. So that, as I said, a very hot topic in the academic and the professional literature is whether companies need to disclose stress testing methodologies or not. As I said, maybe in some industries like the banking industry in the US, now the banks are required to disclose some of these methodologies. Nevertheless, they ignore to disclose other methodologies and so on. So they have to make like some cost-benefit analysis. The cost is relevant to the competitors, know more about our methodologies, and the benefits are relevant to our customers and our regulators and our supervisors, increasing the confidence and therefore maybe reducing the cost of capital and the cost of getting external finance for our firm and expanding and so on. The second challenge is, would supervisory stress testing harm the growth of real economy? Again, this is because maybe many companies or many firms, for example, in the financial sector, in the banking sector, try to restrict the use of capital, to have high capital, and therefore they are not exposed to unexpected stress testing results. So they lower their investment and they reduce their credit to increase their capital, and the overall this could be some kind of problems and restrictions for the whole economy. Again, this is an academic and a professional question. The third challenge is, would supervisory stress testing boost or increase protectionism? So in this case, many supervisors and many regulators would ask some banks and some insurance companies to increase their capital and to reduce their investments to allow for them to enhance the capital they have and their performance. And finally, how to develop and maintain a common framework for supervisory stress testing. And this is now evolving in the US and in the European Union due to, as I said, the DFAST, the Dodd-Frank Act stress test, and the comprehensive capital assessment review, and the annual tests done to the European banks. And here comes the importance of discussions between the regulators or supervisors and their individual banks, so they can enhance the performance of their supervisory stress testing, and also introduce more comprehensive information to the customers and to the stakeholders in the banking sector, also in other types of financial firms. So as we can see, there are future challenges of stress testing. So we are now coming toward the end of our webinar today. The summary, we have found that many financial firms and non-financial firms use their stress tests are part of the enterprise risk management. And it's very important for the risk managers to apply the stress testing on a wide range. And also it enables the managers to reduce their risk to acceptable risk level, what we call the risk appetite and the risk tolerance. And it has to be fitted into the overall governance and risk management culture of the organization. So now we are coming toward the end. I have received some questions about the webinar. Of course, I will not be able to answer all of them, as we have only a couple of minutes until our live webcast ends. But I have question talking about the scenarios. Are those thinking about scenarios? Are those identified in business continuity planning a good starting point? So I would say yes, but not. It is all of them, because if we are talking about the business continuity planning, it has to be updated. If it is updated regularly and frequently, so it can be used as a starting point for your stress testing methodologies, but not just the business continuity plan or the business disruption plan, because you have to think about the professional experience and the professional judgment of external experts. And maybe they are not used in the business continuity plan, but they have to be updated for new circumstances, and therefore I would recommend it again as a starting point, but not everything in the stress testing methodology. Again, to what extent is business interruption insurance an effective risk mitigation strategy? We are not talking about the risk mitigation strategies, we are talking about stress testing, but I would say that the business interruption insurance is one factor that can be used in stress testing, because it can also be used to, when we model stress testing, we have to think about the insurance we have and security we have to protect us against the losses. So again, it is one component of stress testing, but it is not all. Yeah. So this is the main questions I had so far. So we have come to the end of our webinar. Again, as I said, it's very important to do a very comprehensive analysis of your firms and your organization, and then find out how you can improve and apply the stress testing methodology in the more efficient way, in the most efficient way, and also use the results of the stress testing to communicate with your colleagues and with your seniors and with organizations, and also to enhance the feedback system of your organization to benefit from the results of the stress testing within the overall governance and risk structure of your organization. So now we have come to, I hope you have benefited from this webinar, and I was very happy to be with you today, and I hope I have introduced some important concepts and some important advice about how to incorporate the stress testing methodologies and practices and results to enhance the risk resilience and risk exposure of our firm and the company in all types of organizations, whether they are financial or non-financial firms. Thank you so much again, and I'm very happy to have you here with me, and I hope to meet you soon again in another webinar within the Institute of Risk Management. Thank you so much for your following, and have a nice day. Thank you.